Hey, Kevin.
Yes, good morning.
Good
You hear me
morning,
now?
everyone.
Yep,
All right, Kevin. We're here.
we're here,
We're
man.
doing
We're
we're doing
recording.
your nonsense.
We're doing it, man. We're doing it. So I actually have the video recorded and the audio recorded on my end. Kim is here. Kim has it recorded as well. So everyone will
Right.
be able to get a copy of this once it's all said and done with. But today I'd like to first I'd like to say thank you for taking time.
Mhm.
And for those of you who are watching, we've got Mr. Rob Gaskins of CMG Mortgages. And today we're going to be talking about first-time home buyer programs, loans, and grants that are available for first-time home buyers. And we're going to specifically talk about the state of Virginia today, right? And we can talk about the other programs in DC and Maryland another time, but let's focus on Virginia. And yeah, so if you can introduce yourself, let everyone know who you are, what you do, and why you do it.
Well, my son the other day asked me what I do for a living, and my answer to him was I give money to people. So if you want money, I'm your guy. The only caveat behind all that is that you have to eventually pay it back, and with
Yep.
a little bit of interest. So I give money to people. But the main thing I do is I help people get into homes, and I take that piece very, very seriously. Buying a home is one of the most important, stressful, and largest value that you'll ever purchase or make in life in your lifetime. So it's a very, very important thing that happens there. In particular, I love first-time home buyers, and I think today you want me to talk um, more towards kind of Virginia first-time home buyer loans and different products that are out there that can be used. Um, but yeah, both Monica and I, we work for CMG Home Loans. We're a top 10 lender in the United States, and we can do every product under the sun. You name it, we can do it. And we have a good team that works for us. But all right, so you want to go into the VHCA Virginia loans.
Yes,
All
yes. Let's
right.
talk about these. Let's talk about these programs because I get questions about this all the time.
Mm-hmm.
And yeah, so whenever you're ready.
Yeah, so when I'm having my initial consultation with borrowers, I'm always asking a lot of different questions when I'm talking to somebody. I'm asking about their job, I'm asking about their credit score, I'm asking about how much money they have in the bank, what their expectations are in terms of buying a home. One of the biggest, pushbacks that I get from especially first-time home buyers is this thought process that you need 20% to buy a home. I'm hearing some echoing. I don't know whose it is. I can't
Oh,
echo.
did it go away?
I Yes, it went away. Perfect. Okay, wonderful. Um, and so it's this whole thought that you have to have 20% down payment. You don't have to have 20% down payment. In fact, in the state of Virginia, you can get a home with 0% down. In fact, you can get 0% down and you can get some money towards your closing costs, which is absolutely phenomenal. So when somebody comes to me, has a decent credit score, has a decent job, but they say, Rob, I've only saved up like $2,000 or $3,000. There's no way I can buy a home. My answer to them is not necessarily. Let's look at this a different way. Let's look at, hey, can we get you 100% financing? Can we get you some costs to pay for the closing costs? Can Kevin, your agent, go out and get you, some closing costs from the agents? Can we get you into this home without you having to put a dollar on the table, and you're owning a $300,000-$400,000 home, and you're on your way to wealth, the wealth building process of owning that home? So yeah, so in Virginia, there's some 100% financing. There's also some grant money. There's 2% grant money that you can get as well. You don't have to do the 100% financing. Fairfax County has some special grant programs that are there. They're a little bit harder to obtain, but they're there. And other counties have some other programs that are out there. So there are programs out there. Now there are some programs that if you brought it to me and you said, hey, we're thinking about using this program, I would tell you right away, we're not going to use that program. You're never going to, the approval, the length of time it takes you to get approved could take a year, maybe 2 years to get approved for certain programs. All the programs that I know about, we can get them approved quickly, and we can close you in 21 days, 28 days.
Now, are you talking about like grant money that becomes available to the state, and then it's only the grant money only goes to the people that get to it first, and then they have to get approved, and sometimes it takes a month or two to get approved to get that grant money from the state? Is that
Yeah, there's certain pockets, certain programs you can sign up for that sound really good on the surface, but after years and years of experience, I've learned that they never actually happen. Like if you're trying to buy a home in the next 6 months and you're going through one of these grant programs that says, hey, we have to approve you, you have to do this, and then you have to wait in line, and then we have to have the funds that are available, that could take a year or two if it ever happens. And so those are very, sometimes it works, maybe for, 5% of the people it works, but then the other 95 are just left holding the bag and are still renting and haven't gotten into a new home yet. So those are the programs. Like I pride myself in knowing where the programs are at within Virginia, DC, Maryland. And then the programs that don't get as good a review, I kind of will be like, that's not necessarily the way you want to go. Go try it out. You can go, try to figure it out. But I'm telling you, it probably won't work out in the long run.
okay? And what about talk about some of the different loan programs that are available, anywhere from like, conventional, VHDA, FHA, and some of the programs that fall along those different loan programs.
Sure. So just to give you a base with home loans, if you're a first-time home buyer and or you are under a certain income limit, the minimum down payment that you're going to make is 3% for a conventional loan. So 3%. So it's not 20%, it's not 5%, it's not 10%, it's 3%. That's for a first-time home buyer. Okay. Now, if you have lower credit score, and usually my cutoff is around 700, 710. If you're below that, we might try to put you into a loan called an FHA loan. A lot of people think FHA loans are first-time home buyer loans. They're not necessarily first-time home buyer loans. I like to use them more if your credit score is a little bit lower, because you can get a better rate with an FHA loan. It's a government loan. And so we'll get you into an FHA loan. We'll work on getting your credit score higher. And then when the rates drop, we'll refinance you into a conventional. So typically, FHA loans are great loans to start off with. But at some point, you need to refinance into a conventional loan. And the reason for that is on an FHA loan, you can never truly get away from something called mortgage insurance. So mortgage insurance, and this is where the whole 20% down payment mentality comes from. If you don't put 20% down on a conventional loan, you are going to have to pay mortgage insurance. And people don't like paying that extra mortgage insurance. But on a conventional loan, once your property either it appraises or you have enough equity in it, you can get rid of the mortgage insurance once you have 20% of equity in the home. And so that's why eventually on FHA, you can never get rid of the mortgage insurance. So you don't want to keep an FHA forever. You just want to keep it and then refinance it, or you sell the home and get another home. The VA loan one of the best loans out there. If you're a veteran or if you've served, that's a 0% down loan and no mortgage.
No mortgage. That's a
You
fantastic loan program.
get a good rate, you get 0% down, and you don't have to pay mortgage insurance. And so if you have that eligibility, I'll be pushing for that. Now, the caveat on this, and I'm going to go a little bit deeper on that VA loan, all things being equal on a VA loan and a conventional loan, most people, when I say that, I'm meaning if you have a conventional loan, somebody's putting 20% down, a VA loan, somebody's putting 20% down, most sellers are going to take the conventional loan over the VA loan. And why? Because on a VA loan, the appraisals are a little bit stricter and you can't officially get rid of them. On a conventional loan, if you put 20% down, you typically are going to get an appraisal waiver. And you're not even going to have to do an appraisal. But on a VA, you have to do an appraisal. And so those are some of the strategies that we have to work with. You know, I work with Kevin in terms of like figuring out the strategies. What's the best loan product to use? How are we going to win this deal? And so that's where the experience comes in. And having an experienced realtor, having an experienced lender who knows how to navigate these different issues and actually get you into a home. All right, so we went over the conventional 3%. We went over FHA 3.5%. We went over the VA, which is a 0% down loan. There's another loan around our area. You know, I do a couple of these per year. It's a USDA loan. That's another 100% down loan, but that you'd have to be outside the city to use that and to qualify for that one. And there are certain areas that you know you can use it in. We just did one, I think, down in Culpeper. So that's another good loan. The VHDA loans that we just went over, where there's the grant programs, the 2% grant or the 100% financing. So that's another great loan program. And then I'm going to go into one more other loan. This is a little more advanced, but these are called, we call them non-QM loans. What you just need to know is that these loans are not typical loans. They're not controlled and funded by Fannie Mae and Freddie Mac or Ginnie Mae. Those are the ones that give the funding for the FHA, or HUD gives the funding for FHA. Ginnie Mac gives it for VA. Fannie and Freddie are for conventional loans. So a non-QM is basically a private investor coming in and saying, hey, if you give me 12 months of bank statements, if you give me 2 years of 1099s, if you give me blah, 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 there's all kinds of different loans out there that if you can demonstrate that you have some kind of income coming in besides the typical 30-day pay stub, you know, you have a salary, you know, these are great loans for realtors. They're great loans for those who own businesses. You know, maybe you own a nail salon, maybe, you know, you have a restaurant and, you know, the income isn't consistent, but it's coming in. You have a lot of cash flows in, a lot of cash flows out. You know, but your tax returns might be a little bit different than everybody else's. And so that's when we can use those types of loans. The negative on those types of loans is that typically you have to have a 20% down payment and your interest rate is going to be a little bit higher. But to get you into a home and, you know, later on, maybe you can refinance into a better rate. Great. And so there are options for everybody. There are options for condominiums that aren't approved for Fannie Mae, Freddie Mac, or FHA.
But for first time home buyers?
First time. Well, I'm going off the track here on the first time home.
Okay.
But for first time home buyers, if they wanted to, yeah, absolutely.
100%.
So, yeah. So back to the first time home buyers. So there's one thing I want everybody to take away from this. You don't have to have a 20% down payment. Okay. You can do 100% financing. And I'm going to ask Kevin this to see if he knows the answer to this. Kevin, on closing costs for a loan, what is the typical percentage for closing costs on a loan?
3 to 3.5% of whatever you're borrowing, correct?
3. So I would say conservatively, that you're right on, 3% for the sales price of a home. So if Monica came to me today and said, hey, Rob, I'm a first-time home buyer. I want to get into a home. How much money? And I don't want to use any grant programs. I don't want any special programs. I'm not a veteran, nothing. How much money, and I have good credit score. I'm at like at 740. How much money would I need to go buy a home? And I want to buy a $500,000 home. So we talked about is the minimum down payment's 3%. So off of $500,000, that's $15,000, right? But what Kevin just said about the closing costs is going to be another 3%. And so the total out of pocket is going to be $30,000. So you want to buy a $500,000 home, you need $30,000 for closing costs and the down payment. Now, let's say, you know what, Rob, I don't have $30,000. I have $15,000. Well, then I'll say, okay, well, let's structure something where I can give you a grant money for 2%. We still need another percent. Kevin goes negotiates with the seller to get you seller credits of 1%. And now all you're paying is the 3% for the closing costs, and that's $15,000. But then let's say, Rob, I literally have $1,000 in my bank account. Okay, we know we still have to come up with that 6%. We have to come up with that $30,000 for that $500,000 home. How are we going to do it? Well, I'm going to put you into a loan where I'm going to give you 100% financing plus an extra 1.5% towards your closing costs. So now, right now, all you have to do is come up with $7,500. And then Kevin's going to go out and say, all right, I can negotiate with that. And he's going to get another $7,500. All of a sudden, you just got into a house and you didn't even have to take a dollar out of your pocket. And that's the magic of real estate right there. And then we're going to see appreciation of these homes, 3 to 5%. So that $500,000 home that you just bought, the next year, it's going to be worth $515,000. You just made $15,000 and you didn't even take a dollar out of your pocket. And so that's what a lot of, and it's, I've made it very simple. There's a little more intricacies to all of this, but that's the magic of real estate and of buying and of owning property. And then you go buy the next property, you buy the next property, and you just keep doing that. And at some point you're going to have tremendous amounts of wealth. So I'm very,
Understood.
You can tell.
No, absolutely. And of course, your living expense, whether you're paying rent or you're purchasing, is always going to be your biggest expense. And then, of course, with purchasing a home, it's like putting money in the bank every month.
Mm-hmm.
Question about the USDA loans, right? What qualifies for that USDA loan program, and why does the USDA do that?
Those are all really good questions. So there is a website. So I'm not even going to pretend to know how there's all kinds of intricacies of how they qualify a property to be qualified for USDA. I'm not all up to date on all of that. But anybody can throw that in the chat GPT. I'm sure if I did that right now, I'd find out immediately,
100%.
how they qualify. But there's a website we go to, and we throw in the address, and it says automatically that you're qualified, that home is qualified for USDA. And it kind of outlines too kind of the areas that are qualified for USDA.
Yes.
I'm sure it has to do with, the farming, density, all these different factors that
yes.
do it. And then you can qualify, but there's a certain income limit that you have to be under. And like all these first-time home buyer programs, there are income limits. Like you can't be making $1 million and then expect to get a 2% grant, right? You can't be making $1 million and go get a USDA loan with 0% down. Like
that's right.
So they have limitations on the income, and they're healthy. I mean, they're not like they give you a lot of leeway. I mean, you have to be making really good money to not qualify for them. They also have there's sales price limits on the homes too. So there's a certain limit you can't go over. So those are the limitations mainly for USDA and any of these first-time home buyer programs. So.
Excellent. And another quick question: do the first-time home buyer programs vary from county to county?
They do, and you have to be careful of that. Obviously, in the Northern Virginia area, stretching all the way down to basically Fredericksburg to the south, and then past towards Manassas towards the west, you're going to have the higher limits, higher income, higher price points for homes, because the thought process is these are commuter areas for DC. And so we're going to, we know the cost of living is a little bit higher, but once you go further south into Richmond, or you go into different counties in Charlottesville, near Charlottesville, then that limit, the income limit goes down, and the sales price limit goes down as well. And so you just got to be careful with those limits.
Understood. And one other question: how does one qualify to be a first-time home buyer?
Oh, that's a great question. I'm going to ask Monica. Monica, I'm putting you on the spot. What qualifies somebody as a first-time home buyer? Oh, you're muted. You're muted, Monica.
Sorry about that. So the first-time home buyer is going to be someone who has not owned a home in the last 3 years.
Oh man, my training has finally paid off. Okay, that's exactly right. I try to install that in everybody. First-time home buyer, somebody who's not owned a property or is on title to anything for the past 3 years. That means if you own a property 10 years ago and then you sold it 7 years ago, you are now a first-time home buyer. And so go use the programs.
Excellent. Excellent. Right on. Is there anything else that you'd like to throw in? Anything else you'd like to cover?
I mean, I could talk all day long, but I think you have enough. Yeah, go ahead.
I got one more question. Okay.
All right.
Rob, how long have you been in the business?
Too long.
Okay. So what would you say to somebody who is saying that interest rates are too high right now and that they're going to wait, that they feel like it's better to wait?
So there's a couple of things. This is gonna stretch me on for another 5 minutes, Kevin.
That's okay.
So I'm gonna get talking now. That's it. That's first. We acknowledge that, right? Like rates compared to a few years ago, COVID years, are a lot higher. So a lot of people's frame of reference during COVID was these low interest rates in 2% range. Right now they're 6%. So these rates have doubled, which means significant more in your mortgage payment, significant more interest, and then you can't buy the same kind of house, the same purchasing power. So it is a real issue. But historically, if you go down, I challenge you, go put this one in Gemini this time. Go ask Gemini, what are the historical rates for the past 40 years, 60 years? Historically, they're around like 7%. So we're just under historic interest rates. So, if you ask somebody who bought a home with a 14% interest rate, they would have thought that was normal back in that, that time period. So, rates are all relative. But the big thing about rates, and, they have been elevated in the 6%, 7% range for, a few years now. Since 2022 is when they took the big turn. So we've had higher interest rates for about 4 years now, higher in the sense that we think they're higher, right? But it's also sometimes a good time to buy a home when the rates are a little bit higher and people are a little more scared to go buy homes. Like you can get a deal. Maybe you could get the entire closing cost paid for. Maybe you could negotiate $10,000, $15,000 off the price of the home. So you negotiate. The problem comes is when these rates do drop. So one key metric that you need to be aware of is that for every 1% interest rate drop or interest rate going up, you're going to lose or gain 10% purchasing power. So if today's rates are at 6% and you're qualified for a $500,000 home, and then rates go from 6 to 5%, what's your new purchase? What are you qualified for now? Anybody? Come on.
Man,
I'll help you out here. So it's 10%. Okay. So if I go from 6% to 5% and I'm qualified for $500,000, I am now going to be approved for $550,000.
Wow.
So that's where the purchase. So what does that mean for the landscape of real estate? That means that now you have more purchasing power. That same home that you were going to buy at 500, now you could purchase. So that's what causes these escalations. Now you might purchase it for like 510 or 515 because you have more purchasing power. And so whenever rates go down, and typically rates go down during recessions, and the reason they go down during recessions is because the Fed's cutting rates because jobless claims are up and want to stimulate the economy. Whenever that happens, rates go down, but the real estate market always goes up during recessions. There's never been a recession, knock on wood, where home prices have gone down. They've only gone up because you cut the rates down, the buyers come out, and then the prices all of a sudden go up. So that was a long way to get to, if you wait to buy a home, there's an opportunity cost of waiting to buy that home. That $500,000 home, if you wait one whole year to go buy that home, it's going to be 3% higher. So it's going to be $515,000 a year from now.
100%.
But then what if the rates go down by a percentage point? Now all of a sudden you have 10% more purchasing power. So you can buy a home for 550 instead of 500,000. So now that same home that was 515, people might want to buy it for 525. So you have to weigh in these kind of opportunity costs. And I'm not saying all that, immediately go buy a home right now. Everybody's circumstances are a little bit different.
Everyone's different.
Right? If you're going to be living in the area only for a couple of years, or you might be getting transferred somewhere, maybe you keep renting. Maybe you need to build your credit score. Maybe you need to get a new job, make some more money. There's all kinds of different things out there that would limit that. But for the most people, you need to be in a home and you start building that equity.
Understood. Now let me ask you one more question, okay? With today's market and today's interest rates right now, where are they right now? About 6 to 7 between
Yeah, you
that?
got FHA, VA, they're around like 5.875. You have conventional loans like 6.375, 6.5. First time home buyers, you can get down to like 6.25, 6.125. Yeah, so that's where they're at. Jumbo loans can be a little bit higher than that. They can be in the upper 6s. It just all depends on what kind of product you're using. But for the most part, rates are right there in the 6s.
So if somebody's looking to save some money on a property and being saved some money on the property, getting a credit for closing costs or maybe getting a credit to buy down the interest rate, what would you recommend?
Excuse me. Okay, everybody's a little bit different. Everybody looks at money a little bit differently. My bet going into the future is that rates are going to go down. As soon as this war ends, knock on wood again, in Iran, rates will go down. How fast will they go down? Who knows? We got a very pro Fed chair right now who would love to cut rates if he has the ability to do so, and the economy would let him do so. So he's ready to do it. Everybody's ready to do it. Everybody wants the rates to go down. We just can't do it with inflation. So there's inflation going on right now in the economy, especially with the oil. I think it's probably temporary.
Yeah,
but it's still there. So you can't really do anything with the rates while there's the inflation. But I wouldn't necessarily buy down rates, because the break even on buying down a rate can take sometimes like 7 years, 10 years to break even on that. And what I mean by that is, let's say you have a rate of 6% and we can buy your rate down to 5.75, but it's going to cost you $10,000 to get that better rate. Yeah, your mortgage payment is going to be better, but you just spent $10,000 to go down a quarter point. And maybe that only saves you $80 a month, maybe $100 a month, right? So you're only saving $1,200 per year. I plug that $1,200 into that $10,000. All of a sudden, we're at like 7 years, 8 years in the recoup cost. So you're not going to recoup that $10,000 until that 8th year. And I'm going to be like, A, are you going to be living in this house until then? Or B, more likely, rates are going to go down and you're going to refinance. Once you buy down points, that is a sunk cost. So if like in 2 years from now, rates dropped by 1 whole point and you bought your rate down to 5.75 and they go down to 4.75 and you refinance, you lose all that $10,000. You don't get that back.
Good to know.
Yeah. So I encourage people, I say, hey, let's wait for that next big wave of refinances. Let's wait till those rates get down in the 5s, get down in the 4s. And then at that point, if you think you're going to be living, if this is your forever home, let's buy the rate down and get that rate real low, you know? Or is this not your forever home? Okay, it's only going to be 5 years, and let's not buy the rate down because you're going to sell it and you're going to move on from here. So everybody's a little bit different, but you have to look at the numbers. But there are some people out there who will just sell you all day long. Buy down the rate. I'll get you this great rate. And it's not always just about the rate. You got to look at everything, the entire picture, and what's really going to be in your best interest.
Right on, man. Right on. Well, listen, how can somebody get in touch with you if they have more questions on first-time home buyer programs?
We can leave our email address, phone number. I mean, you can put it out there. Contact Kevin. Kevin can get in contact with me.
Excellent.
Very quickly.
Excellent. Yes, because it's not always about the lender or the agent; it's about the team, right?
It is about the team.
And you want to have that team in place, and you want to have a plan in place before you go out and start looking at homes. And that's exactly what we are going to do for you, Rob. I'm going to have all of your contact information down in the description below, and I really appreciate your time. Monica, thank you. Kim, thank you. And that's all I've got for now. So thank you all so much, and until next time.
It was a pleasure. It was a pleasure.
Excellent.
Thank you.
Thank
It
you.
was a pleasure.
Yes, thank you.